Hello everyone, good evening. Welcome to this webinar. Today we'll be discussing about how hybrid funds can offer a smart middle ground to the modern investors. To discuss this and more, we have with us Mr. Arshad Boravake, who is the head of research at Mirae Asset Mutual Fund. He has professional experience of more than 21 years, and his primary responsibility includes investment analysis and research. Prior to this, he was associated with Motilal Oswal Securities Limited as Vice President, Research. He has also been associated with Capmatrix and Risk Solutions as Research Analyst Equity. So, without further ado, I would like to hand over this call to Harshad. Welcome, Harshad. Over to you. Apologies, everyone. There's some technical issue. Harshad would join us shortly. Please bear with us.
Yeah, hi. Good evening, everyone. I hope I am audible. So let's start. So, what we have done is on hybrid mutual funds, we are trying to look at the current market juncture, how as a investors and we, as a fund managers, how we are looking at it. So, it kept this presentation divided in three parts. First is, importance of hybrid funds. Then we have looked at how do hybrid funds actually work. And lastly, then we will look at what are the different hybrid funds at the Mirae Asset Mutual Fund. So let's start with why hybrid funds, right? So this is a chart I am sure many of you would have seen. This is more about you and me as an investor as the market moves through different phases. So how we behave as an investor. So if you look at the first, where we are talking about euphoria. So that is the time where we would have made good returns as an investor. Everyone is enthused about the markets, so that is the phase where typically, as an investor, somebody who is not invested would have a feeling of missing out, what is typically called as FOMO. So that is the period where, many investors would try to pile into the markets, primarily driven by the recent returns, which would have happened. But in the second phase, if you look at, as the markets for some reason, as they, try when the markets go down, so that is a time as an investor, some, as a NAVs could have been in the negative or flattish. So, one would feel people also start at that point in time comparing, returns with FDs. So that is where, people would feel that, this was not the right time to invest into the markets, or, let me stay away from the markets. So emotions play a lot of important role in the investing journey. So, when somebody invests apart from fundamentals, I think the most important, behavioral aspect is, the emotions and how do we react to the different market conditions. So when the markets are at the bottom, typically, one would feel, kind of despondency is the behavior which we are saying which could happen. And people would try to, then not continue to invest or, get away from the markets. Secondly, what we have tried to look at, if you look at asset class behavior, so typically, different asset classes not necessarily would behave similarly at every point in time. So for our discussion, we have limited our asset class discussion to typically two to three factors. One is equity, second is gold, or for that matter, commodity, and third is debt. So as you can see, this is a quilt chart, at different years. The different asset classes has done better in different years. So what we are trying to say here is that, one, markets are volatile. So to that extent, as an investor, one would be subject to the emotions. Secondly, also from the asset class, it's not that I buy one asset class and you would make a decent money. So one has to look at asset allocation. Is asset allocation important? So let's look at the different studies which have been done. So this is the study done long back by Financial Analyst Journal. So there what we tried to look at, what is it that really drives the return? So here, if you can see, so people try to time the market, then there is a security selection or asset selection which happens, but eventually the big money or, the eventual returns are made through asset allocation. So 90, as you can see in the chart, the bigger pie is 91.5% of the time, asset allocation is the one which drives the market. So here we have tried to look in the Indian context, while the study was global, but let's look at in the Indian context. So as you can see on the chart, so there are four, parts to this chart, to this slide. So first is equity. So here what we have done is over the 15-year time period, at what percentage of the time the returns have been varied between different data points. So as you can see in the equity extreme left, so roughly the returns have varied between, let's say, 40 to 45% of the times, return have varied between 12% to 20%. But you should also note that there has been periods of extreme. So, for example, equities, let's say 5% of the time or 3% of the time, returns have been negative. And also at some point in time, there were some small percentage where returns were significantly higher, upwards of 25%. Second asset class, which is gold. So while obviously gold has done quite well, in the recent period, but as you can see, the top bar, in the gold side. So 15% of the time in the last 15 years, gold has given negative returns. So, that's the way asset class is. We are not saying one asset class is good or bad. We are just trying to assess, how the different asset classes are. Debt, which is the third part, on the other hand. So, while the returns are lower, let's say anywhere between 6 to 9%, but almost 75 to 80% of the time, the returns limit between, 6 to 9%. So, what we are trying to say is that each asset class has its own behavior. Each asset class has its typical peculiarity. So as an investor, while one really cannot question why it is X and why it is Y, but this is the way it is. But when if you look at the last chart, what we looked at, what drives the returns, so which is asset allocation. Similarly, we have tried to look at how the portfolio return would be if we try to do asset class allocation on these three asset classes. So we have taken equity at 65%, debt at 25%, and gold at 15%. So on the extreme right, if you look at the bar chart, so I think the performance or the outcome, I would say, is much more stable, much more acceptable, and that also means that if somebody has a portfolio allocation and the returns, as you can see, vary between, let's say, almost 80-85% of the time, the predictability is much higher. Returns vary between, let's say, 8% to 16%. So here, what it does, the asset allocation, what it typically does is that uh, it first, it helps you to stay invested in the equity as asset class. At the same time, it helps you not to have those extreme experiences. For example, the negative, what we saw on the equity side. Secondly, if you also on the gold side, while gold has done well, but there are also times historically where gold has been negative returns. So combination of all these three asset classes helps you to build, I would say, a much better portfolio. So for an example point of view, we have done 65, 20, and 35. So, in terms of mirror asset hybrid funds positioning, so for the discussion, we have excluded arbitrage out of it. So there are four different hybrid funds which we have. So at the extreme left, which is equity savings, while we'll see more in depth, but just to give a summary out here, at the extreme left, we have equity savings, where typically the equity percentage for us varies between, I would say, 35% plus or minus 5 to 7%. On the extreme right, you have aggressive hybrid fund, where equity is between, let's say, 70% plus or minus 5. And in between these two, there are dynamic asset allocation funds. One is balance advantage fund, where you have equity between 30 to 80%. It's driven by model. So model basically suggests what the equity percentage should be, and we mimic that in our portfolio. And lastly, it is multi-asset allocation. So unlike other three funds where you have equity, arbitrage, and debt, on the multi-asset allocation, there is one more asset class which gets added, is commodities. So here typically large part of it is gold for us, and some is silver. Here again, equity can move between 40 to 75%. So let's look at, before going to each hybrid fund. So let's look at how the hybrid funds typically work. So yeah, so let me start. So first, if you or me, were to move across the asset classes, so there is a taxation angle which comes into picture. But in the hybrid funds, that's not the issue, because for the asset classes change within the hybrid fund, so there is no tax incidence. Secondly, when markets move, so for example, let's talk equity markets. When the equity market starts to move up, or if the equity market starts to move down, so for us, the decision to change the asset allocation obviously will depend on different factors apart from taxation. As I said initially, emotions will also play a large part in terms of asset allocation. So here, I think if you look at all the hybrid funds, so typically the rebalancing, I would say, is more automatic. Emotions doesn't really come into play. So let's look at the left hand side, where we have looked at. So let's start with asset allocation between 70% to stocks and 30% to bonds. So as the stocks go up, the percentage, allocation towards, I mean, the percentage within the portfolio will, for the sake of example, let's, moves up to 85% from 70%. So what we do in our hybrid funds, so we, in order to balance, again, it will vary from fund to fund. It's just an example. So when, as the, a percentage of the stocks or, equity moves up, so to balance, we'll reduce it down and again increase the, we'll buy, do it through buying more bonds. So again, the, balance moves to 70/30. On the other hand, at 70/30, the left pie chart, right pie chart. So if, the stocks go down and instead of 70%, stocks percentage goes down to 55%. So there again, what we do in order to, balance go back to 70/30, we again, buy stocks and revert back to 70/30. So this cycle, keeps on happening. It could happen that for few months we'll keep on increasing the equity percentage. For few months, we could decrease the equity percentage. Also, month over month, at 1 month we could increase, second month we could decrease. So it's quite, that's the word, dynamic when we use the word. So it's a quite dynamic allocation which happens between the asset classes. For two of our funds, we have a active underlying framework which I'll come to in a minute. So that's how, that's how the portfolio rebalancing occurs. And just to repeat, the most important part is it's quite a tax efficient way in terms of rebalancing the portfolio, unlike if investor were to do at his own end. So there will be tax element which will come into play, which is not the case in terms of hybrid funds. So if you look at right hand side, there's one example which we have given. So in case of simple 1 lakh rupees invested way back in 1998, without rebalancing, the value could be roughly around 10 lakh rupees, but with rebalancing, the value can be around. So there are some assumptions which go into this example, but just to to show it figuratively, that with rebalancing, we can definitely make higher returns. So to summarize more on the hybrid funds, so first, as I said, investment experience or investor experience is much better. So for example, if you recall, if you go back to COVID period, so if you look at the data, we did see a lot of redemptions happening in the pure equity funds, but that was not the case for hybrid funds. And the reason clearly is in terms of performance, the funds behave much better when markets are volatile. Secondly, it gives a combination of assets. It's just not just not equity. You have equity, debt, also arbitrage, given that equity taxation, which I'll come to that. And then also for the multi-asset, you have commodities, which come into picture. I think the beauty about commodities or gold, for example, is that there is a negative correlation between equity and gold. So to that extent, it's not only diversification, but also, the correlation also works in favor. Thirdly, it's all the hybrid fund allocation is framework driven. So when we say framework driven, which means the emotions doesn't come into play. It is there are definitive underlying fundamental factors which are used to decide what equity percentage should be. And for us in the model, I'll come in a minute, but large part of it is driven to given to price to books and earnings. So to that extent, it's a fundamental driven approach. Equity allocation, as I said, across the funds can vary between 30% to 80%. And if you look at fund returns, so they are driven by two factors. One is what is the allocation between the asset classes, and then second is what do you buy within the each asset class. So for example, equity, while we have a bottom up approach in terms of building the equity portfolios, so what we do is, typically, given the investor profile, which comes into hybrid funds, typically they could be the first time investors, or, who wants to have, higher returns than FD, but at the same time, don't want, volatility, similar to, what pure equity funds have. So there, as by choice, we have kept all our equity portions of our hybrid portfolios large cap biased. So to that extent, given that it's a large cap bias, relatively the volatility is slightly lesser. Uh, Coming to debt, again, it's largely, I would say, the debt portion, while it is managed by our debt fund, typically we invest largely into G-Secs and AAA bonds, depending on our view on interest rate cycle. We, change the overall duration for the fund. On the commodity side, for now, we have large part of in the multi-asset towards gold, and of late, we also increased some percentage on the silver side. So this is largely, I think, all the hybrid funds for us, how they work. Now let's delve into briefly into each of these hybrid funds. Yeah. So yeah, sorry, before that, on the taxation front, so all our, hybrid funds have, equity taxation. So that's one point. So what it means that at any point in time, we need to keep equity and equity equivalent, percentage at least 65%. So for example, let's say, our, framework suggests that equity, should be 50%. So what we do is the difference between 65 and 50, which is 15. So that is allocated towards arbitrage positions. So to that extent, then we are compliant with this 65% for the equity taxation. Yeah. So let's start with the equity savings fund. While this fund was for us incorporated way back in 2018, so it includes three asset classes. One is equity, second is arbitrage, and third is fixed income or debt portion. So here we have slightly looked at how our equity percentage has varied over the last 1 year or so. So what we have looked at is, if you look at recent percentage, equity percentage, so roughly, which is the bottom orange line. So we are at roughly around 43% or so. So what we had done is, when the markets were high somewhere in August, September, so at that point in time we had corrected our equity, and as the market, we have reduced our equity, and again as the markets moved down, we had slightly increased our equity. So over the period, if you look at the history of the fund, at the lowest side, I think we have gone roughly at around 34-35%, and at the higher level we have gone at roughly 44-45%. Second is aggressive hybrid fund. So here, as the name suggests, equity allocation is aggressive. So equity can be anywhere between 65 to 80%, and the rest is roughly 20 to 35% can be debt and money market instruments. And we also have option to invest into REITs or InvITs to the percent of 0 to 10%. So here again, as I said, the equity portion is large cap biased. And if you look at the changes what we have done in the last 1 year or so, so we started with equity of roughly 75-76%. When the markets moved up at around September, October, we had gone down to I think 70 to 73%. But again, when the market corrected, we have increased the equity positions. It's similar to the directional movement is similar to equity saving, but obviously percentages are slightly different. Third is balance advantage fund. So here unlike equity savings or unlike aggressive hybrid where equity percentage are slightly in the narrow band. Here equity percentage can be at a very significant range. At some point in time we can also go down to 30%. At some point in time we can also go up to 80% or so. While this is a quite young fund for us, somewhere in 2022 we had launched. So if you look at the underlying framework, I think this is the important crux, of this fund. So what we have done is we have this last 15 to 17 years daily data points in terms of price to book and price to earnings. So we have given a higher weightage to price to book, almost 75%, and 25% weightage to price to earnings. Again, within the price to earnings, we take trailing as well as forward. So based on this, there is one composite score which comes out. So composite score is nothing but at current or at any given point in time, how does it compare with the history of the last 15, 17 years. So model is run on a daily basis. So figuratively, we have shown at the bottom of this chart, where if you can see at the let's say zero composite score, equity percentage could be around, let's say 60% or so. And let's say as the market moves down or as the markets correct, we will increase the equity percentage. As if you look at as the market's composite score goes down to, let's say, -1, -2.5. So at the max, we can go as high as 80% in terms of equity. And similarly, as the markets move up, we will reduce the equity percentage, and at the lowest end we can go as low as 30%. So I think the important factor to note here is all this is driven by fundamental data points. So to that extent, as a fund manager, we really have, we do, I mean, our emotions don't come into play. While we have kept some some leeway. So if model suggests X percentage, we can be 2.5% away from the model, and that is more of a technical factor because in, let's say, events like budget or when Trump announced something, so there we can those things cannot be captured immediately into the model. So to that extent, there is some flexibility what we have. So this is largely on the model. I mean, just to summarize, we can go as low as 30%, and we can also go as high as 80% out here. Now, again, if you look at last 1 year in terms of equity percentage, I think it has been quite dynamic. So we started, I think, somewhere at around 48, 49%, went down to the extent of, I think, 45, 46%. While these are all month-end numbers, so obviously some are not visible. And again, when the markets moved up, we increased, our equity percentage. Last one is multi-asset allocation fund. So here, as the name suggests, apart from equity, debt, and arbitrage, we have additional asset class, which is commodities. So this is again a recent fund for us. So if you look at the different asset classes which we can buy here, one is equity between 65 to 80, debt 10 to 25, commodity again can be between 10 to 25. We also have option similar to aggressive hybrid fund. We can also buy here REITs and InvITs, and there is also provision to buy foreign equities. On the commodity front, typically, for till now, we have, we largely invested on the gold side and some portion on the silver. In the last few months, we have increased allocation towards silver and eased reduced some exposure towards on the gold side. REITs and InvITs, I think currently, so we used to own some REITs, in the fund. I think there's just one REIT paper which we have. And on the foreign equities, I think given the valuation for now, we are not yet allocated much towards, when nothing on the foreign equities for now. At some point in time, whenever something looks attractive, we will invest towards on the foreign equities side. Similar to balance advantage, again, we have a equity allocation framework out here. So in balance advantage, as you would recall, so we had a price to book and price to earnings. While on the multi-asset allocation, there is slight modification. So we have price to book, again, which has a 75% weightage. And instead of price to earnings, what we have done is it's a difference between bond yield and earnings yield. Bond yield, while everybody knows, earnings yield is nothing but a reverse of PE. So that is earnings yield. So difference between that and then the price to book. So based on that, there is a composite score which comes out. The only difference is in the balance advantage. We had equity between 30 to 80. But here, in the multi-asset, there is an additional asset class. Sorry, which is commodities, which needs to be at least 10%. So instead of 30 to 80, here what we are doing is equity can be between 40 to 70%. That's the difference. Again, there is some flexibility what we have here. So what again, the number of data points are last 16 years daily data points. Model is run on a daily basis. Not necessarily, we will change equity percentages on a daily basis, but directionally for the, let's say, for 1 or 2 or 3 days, in case the composite score moves, then we do change allocation within the fund. And when we change the allocation, not necessarily it is proportionate. It typically is a stock specific approach when we change the equity allocation. If you look at last 1 year, in terms of again percentage, so I think somewhere in June we were at around 51%. As the markets moved up, we went down to 45, 46%. And again, when the markets corrected somewhere at the start of this year, with largely driven by some global volatility, we again increased, the equity percentage out here. I think both balance advantage and aggressive hybrid, the equity movement has been quite dynamic, and almost 90-95% of the time, we have followed, what model has been suggesting in terms of equity percentage. So I think to summarize, I would say if you look at the hybrid funds per se, so one, it gives or it makes investor remain invested in the equity as asset class. As you know, the equity as asset class is quite volatile. So to that extent, when the markets move up, or let's say markets go down, examples are recent is this COVID or way back in 2008 financial crisis. So I know many people at that point in time, were or moved out of the equity market for some time, and I'm basically, that is not the right move, because eventually, as I showed initially, the overall returns are driven by asset allocation and not really by timing the markets. Secondly, I think if you look at any fund, I think frankly, if you ask me, more than the returns of the fund, I think what is more important is the investability of a fund. So when I say by investability, which means that fund over the period, obviously there should be predictability. And as an investor, I should feel comfortable with the strategy. And eventually, as I know, as the people say, more than timing the market, time in the market, is more important. So to that extent, I would say investability in the market, yeah, investability of a fund is more important. And lastly, I would say, hybrid funds, while, they are a asset allocation solution, but according to me, they are more, solution to our behavior, or solution to us as an investor towards the markets. So yeah, I think that's what we wanted to say on the hybrid funds for now. And yeah, if anyone has any questions, we can take those. Thank you.
Thanks, Arshad. Thanks for such an insightful session on the hybrid funds. Participants, in case if you have any questions, you may put in the chat box and we'll try to answer them. So, Arshad, the first question from one of the participants has been you have been managing all the four hybrid funds, equity, savings, BEF, multi-asset. What you've clearly seen is the multi-asset and balance advantage fund, which you alluded to, have an underlying investment framework to decide on the allocation, have been fairly dynamic. How do these fund remain agile in terms of adapting to changing market conditions? If you can just elaborate more on that.
Sure. So I think, as I said, the equity allocation or asset allocation for these two funds is driven by a framework, and framework is basically database framework, in the sense we have this data points which are input on a daily basis. And see, as the market moves, so for example, if you look at let's say last 1 year, right? So there have been periods where markets were down 10%, and there has been two times or three times, if I'm not wrong. And there have been periods market have also moved up 8 to 9%. So to that extent, and then you or me as an investor, so for us it's quite difficult to respond to that immediately. But for the model, I think that's not an issue, given that it is all number driven. So to that extent, model did suggest, if you look at last 1 year, as I showed in the chart, model did suggest, equity percentage moving higher low. So to the extent, I think almost we started last year with almost with 58% in one fund, went down as low as 44, 45%, and then again back to 53%. So I think this dynamism, if you frankly ask me, as an individual, I think it would be quite rare, to change the equity percentage to that extent. So I think that helps, when you have a framework, data-driven framework, it definitely helps to, make those changes. And we had done simulation on these funds for the last 10, 12 years. I think the results are quite decent out there. So that's the reason, we get confidence to follow the model while allocating the equity percentage.
So right, so one is since it is model driven and fund level, you don't have any emotional bias, so that is quite important. And second is obviously tax efficiency. Any buy sell within the fund does not attract any tax
Yeah,
implications. So that
that's
again
also.
is a very good advantage. Harshad, moving to the next question, again on multi-asset and balance advantage fund, there's been significant increase in the equity allocation over the last 6 months or so, particularly from December to June now. So, what have been the factors, underlying factors that have led to this increase? If you can just elaborate more on that.
Sure. So I think two factors. So one is obviously, post Jan, driven by, global volatility, either geopolitics or policy driven. So markets did correct. So to that extent, model did respond, the framework did respond to that correction. And secondly, I think after March, when we had this final FY25 results, the P part, which is price to earnings part, which also includes 1 year forward and 1 year trailing. So one that, year kind of moved to FY, 1 year, one more year. So to that extent, additional earnings or, higher earnings got captured. So I think two factors, as I said, it's market correction plus roll forward of the earnings. So that kind of, dictated the model, the framework to move up the equity allocation, and we largely followed that.
Sure, Harshad. So, Harshad, while you alluded to that you keep a large cap bias allocation with a flexi cap approach across your hybrid funds, one of the arguments is mid and small caps tend to do well, at least they have the potential to do well over the medium to long term. So, from that perspective, don't you think that you should have a relatively higher allocation to mid and small caps?
Sure. So I think, it's by choice that, we want to have higher large cap. And when I say higher large cap, that doesn't mean we are going, 80-90% large cap. So at the lower level, we would have almost at least 60 to 65%, which means 30 to 35% will be mid and small. At right now, if you ask me, we are at around 75 to 77% large cap, and the rest is mid and small. So at any given point in time, while it's a bias, but I think the point is the rest of it is mid and small. And when I say by choice, as I explained earlier, the choice is because the investors who comes to the hybrid funds typically, as I said, they could be the first time investors, people who, for the first time moving away from the FD and, want more than FD, but at the same time, doesn't want equity volatility. So for them to have a smoother experience, I think it makes sense to have a large cap bias. So that's the reason we have large cap bias. But that doesn't mean we don't have mid and small. We also have mid and small within the fund.
So, mid and small cap with a fair balance and a large cap orientation that leads to a better risk adjusted performance and a better investment experience. Fair enough. Harshad, next question is in terms of hedging. While you change the net equity allocation, and this is particularly for multi asset and balance advantage fund, how do you manage the arbitrage or the hedge position? Is it done at a stock level or at an index level, or it is a combination of both? How it is?
So hedging, we do, I think, at a stock level, and it's largely an arbitrage position in the sense whenever we enter into a contract, and whenever we enter, we know, what the returns are. So it's a fully hedged position, and it is largely towards managing that 65 percent. In terms of returns, I think if you look at last 5-7 years, the arbitrage returns have largely followed money market returns, I would say.
One of the participants has been asking, what is the ideal time horizon for investing into these funds? You can have
So I think,
different, yeah.
yeah, see, if you look at equity percentage, so there is a choice, if someone is very conservative, he can look at equity savings, which has the lowest equity percentage, and someone, who is slightly aggressive, but at the same time also want some debt, we can look at hybrid fund. But typically, I would say equity savings one can have 1 to 3 year kind of investment horizon, and as you move up equity percentage, the investment horizon could be higher. But I think if you want the lowest horizon, I think equity savings is the one one can look at.
So, Mr. Apar Goel has been asking, in the current market scenario with increased global uncertainties, changing valuations, uh, changing macro dynamics, domestic and global, change in interest rates, how a multi-asset allocation fund can help in adapting across equity, debt, and commodity as an asset class? What could be the key drivers or what could be the underlying framework that can be used to determine the suitable allocation within these asset classes, which can help ride through this volatility?
Sure. I think multi-asset, at least for the last 1 year, have been in the sweet spot. primarily because if you look at global volatility, which is driven by, as I said, both policy uncertainty as well as geopolitics. So that has prompted, a lot of central banks to, buy gold, as a reserve. So to that extent, we had good, decent returns on the gold asset class. And multi-asset, as has commodity as a portion. So that has clearly helped. We had, I think, almost 12.5% towards commodity. So that has definitely helped, in terms of, making slightly better returns vis-a-vis, some other funds which don't have commodities. That's point number one. Secondly, I think because, I mean, it could be repetition, but because it was a framework driven, so even if markets were volatile, but at the same time, model also responded to that market volatility. So that's the reason we were able to change the equity percentage and take advantage of it. So volatility, some people call it as risk, but we look at it more as an opportunity. And I think the framework is taking benefit of that opportunity. Thirdly, I think while we do have flexibility to invest, into foreign equities and all, but for now we are not doing that given the valuation. But I think the extra delta, which we got in the multi-asset was again driven by the commodity, again gold within that.
Sure, sure, Harshad. So, Harshad, while you alluded and even there was quite a few times mention about taxation, if you can just reiterate for the benefit of our investors, what would be the tax implication in case if fund is buying or selling? When would the tax implication arise for the investor?
No, I think so. Unlike so if you or me were to, let's say, sell equity or sell debt. So debt, for example, I mean both they have different taxation. But for the fund, either we buy or sell, there is no taxation from on our side. So to that extent, we can dynamically move our percentages across assets. So I think it's a inbuilt advantage which mutual fund as a vehicle has, which is not possible for us at an individual level when we want to move across asset classes. And secondly, I think if you look at all our hybrid funds, they do have equity taxation as a taxation, which I feel at the current juncture is slightly better taxation regime.
Fair enough. Harshad, funds across your hybrid funds have been doing well, particularly over the last 1 year period. So, if you can just highlight what have been the key drivers for this performance rebound?
Sure. I think apart from, as I said, returns are driven by two factors, right? One is asset allocation, and second is what we buy within the equity. So here, I think what has helped for us is, our higher allocation towards private banks. So I think that has done well. Then we also had a contra call on the pharma. I think that has done well. Auto in the earlier period, we were overweight. I think that has also helped us. Uh, and I think our underweight position on, cap goods or, some PSU names. So while we suffered, 1.5 years back because of this underweight position, but in the last 1 year, I think being underweight on all these theme has definitely helped us. And then I think some underweights on FMCG and on has helped, and some small sectors like overweight on aviation. I think that has helped. Now, for now, if you ask me, so we continue to remain overweight on private financials. We continue to like pharma despite the run up. I think higher allocation of late we also done towards consumption or consumer discretionary, I would say, which is not, I mean, which also includes retail, building materials, and all those subsectors. Underweight position for us right now are more on the global sectors like oil and gas, and IT to some extent. Metals were opportunistically, slightly overweight ferrous, underweight non-ferrous. That's what we are doing. So that's largely the sector positioning. So I think the returns or funds doing well is more driven by this sector positioning.
Sure. Mr. Krishna Pavulari is asking that can he invest in any of the hybrid funds for his retirement, and can he opt for SWP, which is systematic withdrawal plan? So would you like to address this question?
No, sure. I think first, obviously, he should take help of his, advisor in terms of, what is the suitable product for him. But as I said, I think all these four products do have, debt elements. So to that extent, the experience as an investor, would be much better vis-a-vis, equity. But I think in terms of specific guidance, I think it's better to, take help of the investment advisor.
Sure, Arshad. So we don't have any further questions. So any final thoughts, closing remarks, if you have?
No, I think that would be all from my side. And yeah, if anyone has any questions, they can obviously touch base with our Mire Asset team or through some social media handles. Yeah.
Thank you, Arshad. Thanks, participants, for joining into this call. Thanks for your participation. Have a nice evening. Thank you.
Thank you all. Take care. Bye.